Let me ask you about this big trend with multi-asset solutions.
Okay.
Why is it so popular? Is it about trying to just manage risk in what has been such a difficult trading environment?
I think it's a combination of two things. One is managing risk, and the other is looking for appropriate levels of return in what has been a very long period of low interest rates, and also forward-looking projected period of low interest rates. So how do you provide an acceptable income for investors with the right level of risk? And that's where I think multi-asset has taken off, and the ability to switch between asset classes to deliver that.
What's the appetite for multi-asset investing in Europe now versus where it has been and compared to the States, for instance?
Well, if you look at the last 3 years, it's been growing, I think, year on year. Major markets which has really taken into multi-asset investing in a big way. I think Italy was the largest in terms of flows, almost double that of Germany last year. And then UK and Spain also very strong markets for multi-asset investing as people seek that combination of an acceptable level of income for an acceptable level of risk.
From the outside in, it looks a bit like it's just a rebranding by some of the big fund managers. They've seen outflows across the course of the last several quarters, and they've rebranded the business into multi-asset solutions. Is this not just a marketing pitch? Is it more about something that appeals to the investor? The skeptic in me is saying it's just a marketing pitch.
I think, there is that school of thought out there. And if you look across the multi-asset spectrum, I think you'll find different types of products. Those that do fall into perhaps the rebranded managed fund category, and those that have embracing, I think, new tools to also, limit the downside risk, and also look at sort of different factor-based portfolios, and also increasingly the use of passives to deliver that end return.
When you say factor-based investing, this is about the robo-advisor using some of the machines, bringing in the computers to try and trim costs. Where is this story going? Do you see a point in time where investors will be comfortable handing their money over to machines?
I think we're a little way off from that. I think what you're seeing at the moment is technology and robo-advice being used to drive down the total costs to the end investor, and certainly to deliver products to those that may not want to pay for financial advice, given what's been going on within the region. But what we are seeing is a reluctance for people to part with their hard-earned money without actually speaking to somebody. So the model at the moment seems to be a combination of robo-advice and technology to reduce the cost of delivery, coupled with human interaction to give people the confidence to part with their hard-earned money.